Well, hello everyone, and welcome to the Money Max account presentation presented by United Financial Freedom, where we are buying America back one family at a time. We're so excited to have you all on the call. The owners of the company were listed as one of the fastest growing companies in the Utah region for a 3-year period. They were in the mortgage industry, and through 2004, 2005, they started recognizing significance, true significance, and the debt problem in America with their clients coming back for second and third refinances inside of 3 to 4 year periods. They thought there had to be a better way. They started seeking solutions. They came across a couple concepts and ideas, pulled these all together, did the IT development, and came up with the first iteration of the Money Max account program. And currently to date, we have over 70,000 clients. And in 2005, 2006, we did a beta test with 400 homeowners on this product. And our average client 1 year later was 20% ahead of the schedule we had originally given them for debt payoff. We hear this terminology, disruptive technology, thrown around a lot, and let me just clear up what it means. Disruptive technology is any technology that steps to the forefront and replaces old technology because it has better function, better attributes. Back in 2004, 2005, 2006, when we first launched, with the first iteration of the Money Max account program, we were disruptive technology at that time. Nobody was even in the arena of debt elimination. You had debt consolidation and many other things, debt negotiation, refinance, all those, but no one was truly in debt elimination. I'm here to tell you, in 2021, we have never stopped developing the product. We've never stopped improving, and we are the disruptive technology for debt elimination in 2021. Tonight, I'm going to go over some banking principles and products and show you how when these are all combined together, they create the most devastating debt elimination system that's ever been devised. We're going to talk tonight about closed-end loans, interest accumulation, mortgage amortization, interest cancellation, open-end credit lines, float and leverage, offset accounts, and strategic debt payoff. Let's just dive right in to closed-end loans. A closed-end loan requires a minimum of full scheduled payment. It allows payment in with no withdrawals. It's driven by an amortization schedule. Any money applied does not affect interest charges until the following month, and it calculates interest charges from the month-end principal balance. What do I want you to know from this type of loan? It's too restrictive. The monthly payment never changes unless you refinance. And this type of loan accumulates way too much interest way too fast. And that's what we're going to be talking about, is how do we defeat this. Let's look at interest accumulation. If I have a $200,000 mortgage at 6% over 360 months, my monthly payment is $1,199.10. I left off the 10 cents for simplicity. I'm bringing it up in case somebody has me on a calculator. If I make every single payment on time, I pay back $431,677 following my schedule. That means I borrowed $200,000 in principal loan amount. I'm going to pay back $231,677 in interest alone, and they have the nerve to call that a 6% loan. See, the real cost of your home, if you follow the bank's schedule, is $431,677. Let's talk to you about mortgage amortization. Now, this is the actual amortization for that $200,000 mortgage. And my first payment of $1,199.10, $199.10 goes to principal, and $1,000 goes to interest. We can see that represents 83% of that payment goes to interest. Now, as we proceed, a little bit more money goes towards principal and a little less money goes to interest. And we can see in month 2, my principal contribution increased by a whopping $1. Is it any wonder that it takes us 30 years to pay off this type of mortgage? Year 1, I want you to start looking now in the equity and paid column. I've paid in $14,389, but my equity position is only $2,400. Year 5 was a bit of an eye-opener for me. I would have paid in $71,946, and my equity position would only be $13,891. That means $58,055 of interest has already been paid on this loan. Year 10, $143,000 paid in, $32 is my equity position. And in year 21, look at this, I finally hit the halfway mark with a balance of $99,877. That's my halfway point. Look at the paid column though. I've already paid $302,173 in interest. That is just ridiculous. You know, if I carry this loan all the way out and just follow the bank's program, their schedule, and pay back that full $431,677, I actually paid back at a rate of 115% interest. Now, I know a lot of you are saying, Mac, you know, in my neighborhood, you can't buy a shed for $200,000, but it's all relative when you're talking about money and you're talking about interest rates. Let's look at a mortgage for $300,000 at 4%. In year one, you're still paying 69.26% interest. Year five, you're still paying 63.94. Year 10, you're at 55.97. In year 15, you're at 46.24% interest. That is just ridiculous, and there is a better way. Okay, now I want to talk to you about the concept of interest cancellation. Okay. Now, from the last screen, we know the amortization schedule is divided in principal and interest. What I want you to know from this schedule is that principal and interest is always locked together. If you do something to principal, it affects the interest. So let's say we made our first payment in the amount of $1,199.10. And let's say in September, I decided I want to pay additional money to principal on my mortgage. So I total up the principal that would represent October, November, December, January, and February. Okay. So I'm going to send my check for $1,199.10, and I'm going to direct $1,010.54 be applied to principal by either clicking the box and sending that additional amount, or sending an additional check, directing them to apply that money to principal. Now, here's what I need you to see here. I've totaled up October through February. I'm prepaying that. So what do you think happens to the interest associated with those months? Absolutely correct. October, November, December, January, and February's interest are wiped out of the amortization schedule. That saves us $4,984 off the back end of the loan. Basically, what you did was you invested $1,010.54 in yourself and saved $4,984 of interest. Great return on your investment. Now, I know a lot of people are saying, Mac, that's not really a true investment return, but I beg to differ with you. You signed a contract for 30 years. If you can reduce the amount of time it takes you to pay back that loan and reduce the amount of interest you were scheduled to pay, that is a return on your investment, especially if it's a home. Now, there's one other point I want to bring to your attention. Even though we've prepaid October through February's principal, we still have to make our second payment in October. But the reality is, instead of $200.10 going to principal in October, we will actually be making March's payment in October, which will represent roughly $205.15 applied to principal on our second payment. Remember, that's supposed to increase by $1 a month. We just increased it in 1 month by $5. All of these pieces add up to give you excellent debt elimination. All right, so let's up the ante. Let's say we took $5,000 and applied that to principal with our first payment of $1,199.10. Well, here's what it looks like. Our $200,000 original loan balance is now $194,800. We're still at 6%. We still have a payment of $1,199. But the reality is, now by doing that $5,000 contribution to principal, my amortization schedule in 1 month has shifted all the way up to payment 337. That means I've eliminated 23 mortgage payments. I was supposed to pay back $231,677. Now I will only pay back $208,373. That's a net savings of $23,304 with a one-time $5,000 application to principal. Amazing results. I don't know how many of you are aware that is what would happen. Okay. So I know many of you are saying, okay, that all looks good on paper, but Mac, if I had an extra $5,000, I'd just be sending it, or maybe you wouldn't, or maybe the question is, where do I get that extra $5,000? Well, let's look at another banking product. This is called an open-end credit line. You have the ability to make multiple payments and withdrawals, money in and money out. It uses an interest factor to calculate interest, no amortization schedule, money applied to DFX balance today, and it calculates interest on the daily balance. What do I want you to know about this account? It is very flexible. We can actually use this account to create a degree of arbitrage and float. We can use this account to offset balances. We can use this account as a place to set money as an offset account. All of these different functions come through this open-end line of credit because of its flexibility and the way it's created by the lender. So now, just to bring this to bear so you understand credit lines, a credit card would be a great example of a credit line. A credit card is not what you want to use to drive the Money Max account program, but a credit card is a great example of an open-end credit line. And many of us in the world today, we use our major credit card for all of our living expenses, so our money can sit in our savings account or sit against balances in other accounts. And the whole idea is that when you pay all of your living expenses or you do a shopping spree, you get your bill in the mail. What do most consumers try to do? And the answer is always the same. Pay the Visa bill in full at the end of the month so you can float the interest. See, the reality is if you pay that balance at the end of the month, it doesn't matter if the credit card interest is 2% or 22%. You will leverage the lender's money interest-free for 25 to 30 days just by paying that balance off. And what everybody on this call has just told me they are aware of is a way to borrow the bank's money interest-free, and in fact, borrow it interest-free and actually get awards points, sky miles, bonuses, all other kind of things with that. So this is an integral part of understanding how finance operates. See, banks are smart. They use the concept of no stagnant money. Money works for you. They use money to do what smart investors do, and that means moving the right amount of money at the right time from one account to another account and letting it sit for the right length of time. Now, many of you are saying that's too simplistic. Well, yes, it is, but that is the basic concept. In banks and financial institutions, they have an army of people that are out there making these plays and these movements of money. Who do you have? You have yourself and maybe your financial planner. See, banks understand that money works 24 hours a day, 7 days a week, 365 days a year. So your money is the best employee you will ever have. It never calls in sick, it never complains, and it never shows up late. Money is the best employee you will ever have. Learn how to use your money correctly. Don't you think it's time that we all learned how to bank like a bank? All right, so offset accounts is an integral part of how our program comes together to eliminate debt. Offset accounts, the most common, are home equity lines, personal lines, commercial, secured, unsecured, checking and savings accounts. And yes, some insurance products will operate in this capacity. So let's give you the basic concept of an offset account, okay? Now, remember I said, earlier I said, that example of $5,000 being applied to principal, that looked great on paper, but where would you come up with the $5,000? Well, let me ask you a question before that. Has there ever been a place in your life financially where you would use 10% money to pay off 6% money? Now let that soak in. I didn't make a mistake. Has there ever been a place that you would use 10% to pay off 6% money? And the answer typically is no. That flies in the face of everything you learn financially. You may use 6% money to pay off 10% money. But I'm here to show you again, going back to that floating leverage, that it's not the interest rate that matters. It is the type of product you are using and how you use it. Let's say I have a home equity line of credit or a secured line of credit at 10%. That's represented on the right side in blue. And I have a mortgage at 6%, and that's a closed-end loan. The blue is an open-end line of credit, okay? What if I borrowed the $5,000 from the line of credit and paid it to the mortgage? Well, we obviously know that the balance is going to go down on the mortgage by the $5,000 plus my regular monthly payment, and it's going to increase the balance over on my line of credit to the $5,000 I sent. But I don't want you to see this as I paid $5,000 off on the line of credit. I want you to think about this as I transferred $5,000 of balance from a loan I can't control, that closed-end 6% mortgage, to a balance and a line of credit that I can control. Now watch this. By doing that, we know we save $23,304. We eliminate 23 mortgage payments. But my monthly payment, my interest payment on that $5,000 at 10% interest is $41.67. Now, we also know as we pay a line of credit balance down, the monthly payment goes down. But for our example here, we're going to say on the line of credit for $5,000 at 10%, the monthly payment is $50 even. You want to write that down to make it simple. We're also going to say, as we pay the balance down on the line of credit, the monthly payment's going to stay at $50. That's not going to happen, but I'm going to keep it there to keep the numbers simple, okay? So you ready? We sent the $5,000 of the mortgage. We now have a payment of $41.67 on the line of credit. Let's say at $50 a month, it takes my client 6 months to pay back the full $5,000. At $50 a month over 6 months, that's $300 in interest we paid on the line of credit to save $23,304 on the mortgage. Sounds great, doesn't it? All right, you can't pay it off at 6 months. Let's say our client takes a year to pay the $5,000 back to the line of credit at $50 a month over 12 months. That would represent $600 in interest we paid on the line of credit to save $23,304 on the mortgage. Sounds, let's make it ridiculous. Let's say it takes our client 5 years to pay back the full $5,000 to the line of credit. At $50 a month, that means they would spend $3,000 of interest on the line of credit to save $23,304 on the mortgage. Where does that number start looking ridiculous? Somewhere around the amount of interest you're paying on the line of credit dwarfs or equals the amount of interest you're going to save on the mortgage. And in this equation, that would not happen over a 30-year period. Let's take this concept a little bit further, and I'm going to institute how you can kind of operate this if you were trying to do it manually. We're going to say you make $5,000 a month in income. That's the paycheck, and $4,000 in expenses, okay? I've taken the $5,000 and I've sent it over to the mortgage. I'm already saving $23,000 on the mortgage, and I have a $5,000 balance on my line of credit. Now, I'm going to get a $5,000 paycheck, and most people would put it in their checking account and just let it sit there ready to be spent. But I'm going to use this to compress a balance. This is the offset account basic concept. I'm going to take my paycheck and I'm going to pay it to my line of credit for $5,000. Now, my balance on my line of credit is now zero. How much interest can they charge me on the line of credit as long as I keep it there? Zero. Throughout the course of the month, what I'm going to use is my major credit card with Sky Miles Rewards or Cashback to pay for all of my living expenses. My $4,000 of living expenses are going to go on the credit card. At the very end of the month, I'm going to get my bill in the mail for the credit card for $4,000. What do you think I'm going to do? I'm going to do one transfer or write one check from my line of credit, and I'm going to pay the credit card balance to zero, which means I pay no interest on the credit card. I pick up my Sky Miles Rewards points and cashback. I paid little to no interest at all on the HELOC, maybe 1 or 2 days of interest on that equity line of credit. But my balance pops up to $4,000 for the living expenses. But what's getting ready to happen? I'm going to get another paycheck. I'm going to deposit, compress the balance, and I'm going to wash, rinse, repeat. All right, so the program, even if you could pull all of that together and do it manually yourself, you still would be confronted. If, let's just say you had these 6 debts, which debt would you identify? Which debt would you concentrate on? Would you concentrate on the one with the highest interest rate and the lowest payment? Would you concentrate on the lowest payment with the lowest interest rate, the lowest payment, the lowest balance? Would you send a little bit of additional money to each one of these debts? And the reality is, if you listen or read the books from the debt gurus that are on the market today, you know who they are. None of them can agree on what is the best way to get out of debt. They all use their own personal experience as kind of the catalyst for what makes the best sense for getting out of debt. All other systems that are available on the market today are manually operated by you. They are not interactive like our program. Well, see, here's the reality. Our program makes those tough decisions for you because we do not use conjecture or experience or what we think. We use mathematics. So the reality is, try to do this without a system. No one has the system. No one has the time. It's complicated. It's complex. And even if you figured all of it out, how to use all those accounts, you'd still have to figure out what debt to concentrate on and when. But we have the answer because technology has finally caught up with personal finance with the first and only financial GPS. Why do we call it a financial GPS? A navigational GPS, you put in your coordinates of where you want to go, tells you how to get from point A to point B the quickest way possible. It gives you driving directions. With our financial GPS, the program tells you how much money to move, the exact dollar amount, when to move it, the exact date, from what account to what account, the most efficient accounts, and will calculate the most strategic mathematical solution to zero debt on its own. There's no calculations that you have to do. This financial GPS looks at every aspect of your personal debt, amount owed, term of each debt, interest rate, payment, income, and expenses. It has all of the variables. So when you put all this information into the Money Max account program, it sees point A as all of the debt that you currently have, and it sees point B as I'm out of debt, I've arrived at debt freedom lane, so to speak. Now, there's another function of a navigational GPS. When you make a wrong turn, when you get off track, when there's a road closure, the GPS automatically comes on and gives you new driving directions, or what we would call course correction, to get you back on track to the quickest way to arrive at your end destination. What I want you to understand is when you first start out with the GPS is leading you. When you make a wrong turn or there's a course correction needed, the GPS is now following you. That is unheard of in anything in finance, but we were able to accommodate this by saying when unexpected events occur in your financial journey, medical bills, car repairs, etc., life happening, you just tell the program the new information that's coming in, the medical bill, the car repair, whatever it is that was out of that, and your program will automatically recalculate the next quickest path for you to zero out your debt. In other words, the program is a financial program that not only has the ability to lead you, but has the ability to follow you when unforeseen circumstances occur. There is no system on the market today that has the ability to do that and adjust in real time for user ergonomics. All right, let's look at strategic debt payoff. How does this work? Well, this is incorporated in the Money Max account program as well. You have your checking account and money comes in. It tells you to look at your offset account and send your money over there to compress balance as much as you can. You get another paycheck. It tells you to send the money over there to compress the balance even further. Now, remember, any money that goes over to your offset account, you have access to it. And if you are incorporating a credit card for living expenses, your money can just sit there. Once you're at the right point on your offset account, the program looks at all of your debts individually and simultaneously. It generates another funds transfer and tells you to take a very specific dollar amount, the exact date, the exact dollar amount, what account to what account, to pay it off the quickest way possible. It's all done by mathematics. So let's take you through a couple months real quick. I'm going to go through this pretty fast now. In this example, I cannot incorporate the credit card because it would just be too complex to track all of those pieces. So what I'm going to use is my offset account as my line of credit, and that's where I'm going to deposit my money. That's where I'm going to pay my living expenses, and that's where I'm going to pay my funds transfers that the program tells me it wants to generate. I'm going to be working off of a budget of $4,000 of living expenses, as we saw earlier, and $5,000 of net income, giving us discretionary income of $1,000. Our average client that comes on board with the program has discretionary income between $25 and $250. This right here is your first look at the Money Max account program. This body is called the action plan. It gives you 3 months in advance view of what money is going to be due, what paychecks are coming in, what funds transfers are upcoming, the movement of your money over a 3-month view. This top section is called the dashboard, and this is like your motivator. This is telling our client with that $200,000 mortgage that they can pay it off in 9.9 years. They'll only pay back $67,076 of interest. That means they have the potential to save $164,600 in interest. This line item right here is the teeth of the Money Max account program. This is called a funds transfer, and it's always indicated by those 2 red arrows over to the right. It is telling the date, the account to take the money from, the account to pay the money to, and the exact dollar amount. So in our first month, we should have gone up with a principal contribution of $1. If we transfer that $6,387.93, our principal contribution jumps in 1 month $32, $33 to $232.04, and we move from payment $359 to payment $330 on the amortization schedule. By doing this, we cancel $29,215 of interest, and we eliminate 29 mortgage payments off the back end of the loan. All right, so month one, it ends us with a balance of $5,387.93 with that $6,387 transfer, $4,000 expenses, $5,000 income. My interest payment for that month is $44.90, giving me a new balance of $5,432. We know I canceled $29,000 in interest, eliminated 29 mortgage payments. We move over to month two, and we carry that balance over. We charge our $4,000 of living expenses on the line of credit. We give it our income of $5,000, gives us a new ending balance of $4,432. We pay $36.94 for the use of the money on the line of credit and interest, giving us a new line of credit balance of $4,469. Carry that balance to month three. We have our $4,000 of living expenses, gives us a balance of $8,469.77. We give it our $5,000 of income, gives us a new balance of $3,469.77. And in doing this, my new interest charges are $28.91. That gives me a new balance of $3,498.68. Now, you notice in month two and month three, the program is not telling me to do a funds transfer. The reason it's not telling me to do a funds transfer is the program is now concentrating on repaying that line of credit. You can see the ending balance on the line of credit going down, and the amount of interest we're paying is going down. Month four, we transfer over that balance. We do our $4,000 of living expenses. We give it our $5,000 of income. And the program says, you know what, your balance is low enough. Let's do another funds transfer of $4,231.62. And that's money being applied from the line of credit to principal on the primary mortgage. That gives us a new interest charge of $56.09. And that gives us a new balance of $6,786. Over 4 months, we paid $166.80 in interest on the line of credit. We've canceled $45,666 of future interest on the mortgage, and we've eliminated 46 mortgage payments. Now, month five, month six, we know the program is concentrating paying back the line of credit. By month seven, we have a balance of $4,874. We give it our expenses. We pay it the $5,000. The program says your balance is low enough again. Let's do another funds transfer for $3,911. We now have a new interest charge of $64.88 with a new balance of $7,850.82. Now look at this. Over a 7-month total period, we paid $320.23 of interest on the line of credit, but we've canceled $59,153 of interest off the primary mortgage and eliminated 61 payments. That's 5 years. This is just absolutely amazing that a program can do this. We see month five, month six, we're just paying back. Month seven, program initiates that big funds transfer. We get another principal jump of $20.86. Over that 8-month period, our principal contribution is increased by $81. Remember, that's only supposed to increase by $1 a month. So we're getting the benefit of the increase of our principal contribution on each payment, as well as the decrease of principal on the program with the funds transfers. $59,000 of interest and 61 mortgage payments. Our dashboard for our client now says they can pay off in 9.3 years, hence the motivation. They only have $60,424 in interest remaining. They still have the potential to save $164,600, but they've already eliminated $59,153 of interest. The program's telling them to do another funds transfer in September of $2,934.30. Well, these are kind of your choices. You know, do you do the conventional plan, $200,000, or take the money max? In 7 months, conventionally, you'd have a balance of $198,585. With the money max, you potentially have a balance of $183,769. It would take you 5.7 years of conventional scheduled payments to get to a balance of $183,922. 30-year payoff or 9.9-year payoff, pay back $231,677 interest, or potentially pay back $67,077. I think it's really simple. I like 9.9 years. I like the idea of saving money and not giving it to the bank, but I want you all to dream for just a moment. What could you potentially do with as much as 20 years of mortgage payments to bolster your retirement, vacation home, whatever it is, so you can actually retire with dignity. See, the Money Max account program for all of our clients, the end goal, I have given you every feature of that Money Max account program as far as the different types of accounts that are used in this highly aggressive debt elimination system. But many clients cannot put all of those aspects into play immediately. Some people don't have lines of credit. Some people don't have great credit. Some people don't have great equity. So we designed the Money Max account program that you can use all of these functions, from home equity, personal line, commercial secured, float, credit card, to be able to pay off your debts throughout the month and then pay that back. But we have the program working with just a checking and savings account, and it just works the opposite way as it operates with the line of credit. It is telling you very specific dollar amounts of money to dump into your savings account. And as that savings account increases, it'll get to an optimum point for the program. We'll say, all right, you have enough money in savings. Let's generate a funds transfer. Let's look at the debts individually and simultaneously, and you pay your money here. Okay. We are backed by science as the first interactive debt elimination program. We connect over 13,000 banks and lenders. We're web-based for connectivity and security, lifetime program updates at no charge, and mathematical engines driven by complex banking algorithms and systems. That is United Financial Freedom and the Money Max account program, where there is no magic, it's just math. We provide live client support, live chat, live training, online video tutorials, online blog, and continuing education. With over $19 million in development cost, as of June 21 of 2021, we have helped our clients eliminate $2.213 billion. If you believe everything that I just said, how many families do you think need the message and product? Do you want to leave a legacy of wealth or debt? How would this impact your family? How would it impact your community? To date, we've helped our clients pay off $2.213 billion. So we know our impact. We are all working together as a team to convert consumer debt into wealth and buy America back one family at a time. Many times, achieving your financial goals begins with getting your debt in line and paying off your debt and eliminating that debt. Ask the agent who invited you to this program to run your free savings report, which is a side-by-side of what you're currently doing scheduled with the lender and what you could have with United Financial Freedom. Let the numbers do the talking. Don't delay. Do it today. Get with the agent that advised you and find out how United Financial Freedom can build a better tomorrow for you today. What do you have to lose? Well, I can tell you. 10s, 15s, 20s, if not hundreds of thousands of dollars of interest needlessly paid to the lender back in your pocket, and 5, 10, 15, maybe 20 years knocked off of your current debt struggle. Get with us, get with the agent, let them run your numbers and find out how United Financial Freedom can build a brighter tomorrow for you today.